Here is the story of Cytonn investment scandal, where investors ended up losing 15 billion Kenya shillings. The stage is set. On the 14th of March 2018, a financial advisor from Cytonn Investments reached out to me on LinkedIn and pitched a high-yield investment product known as Cytonn Project Notes, CPN. The product offered 20% interest per annum for a minimum of 1 million Kenyan shillings investment locked in for 3 years. We discussed the pros and cons over a few days, but I needed additional information since I had never heard of Cytonn. I poured myself onto the internet to research the little-known company. I landed upon a highly charged discussion on the investment discussion website Wazua. Two camps debated on the Cytonn offer. Pro-Cytonn debaters were made up of current investors, and anti-Cytonn made up of analysts who preferred not to invest. The bone of contention lay in the 20% per annum offered by Cytonn. The analysts quipped that it is unrealistic to achieve such returns in the Kenyan market. Other funds haven't been able to get similar returns. On the investor side, the call to invest lay in the idea that Cytonn exploited a real estate financing gap by jumping the banks and raising capital straight from the public, therefore offering a 20% annual return. The real estate market in Nairobi grew at a fairly good rate, and the plan seems sound. On the contrary, the analysts questioned why other developers and funds haven't figured out this funding scheme. The answer was a simple lack of imagination. Armed with the information, I checked back with the financial advisor from Cytonn. My concern lay with a guarantee on the returns. I was sold on the promise that the investment is backed by real estate development, and the worst-case scenario would be the sale of the property to recover the funds. At the time, I was building a small nest of savings from my day job. Over 6 years, I did manage to save a little more than 1 million Kenyan shillings. It was time to put the shillings into action. The risk felt manageable, so I wired 1 million Kenyan shillings to Standard Chartered Bank as instructed by the financial advisor. 3 years down the line, I would learn a brutal lesson about risk. The risk for 2.5 years, I received the interest biannually, on time and straight to my bank account. It feels good to receive money when you did not wake up and go to work for the cash. In total, I received about 500,000 Kenyan shillings, minus taxes, in 2.5 years. 1 month into the end of the 3-year lock-in period, Cytonn sent an email to all investors to effect that the principal amount and interest will not be redeemable. The amount would be bundled up and rolled over for another 6 months. It was right in the heart of the pandemic. I was out of a job and needed the money urgently to take care of other pressing concerns. The 6 months came to an end, and the investment rolled over for another 6 months without interest, until finally, Cytonn convened a meeting with investors to announce the company can no longer pay out both the interest and principal amount. The fund has to be restructured. In the period that I was enjoying the interest, I had managed to convince my charmer to sink in 500,000 Kenyan shillings into Cytonn, since it seemed a sound investment. Now, I had to explain the risk to everyone in the group. The charmer never got to enjoy any interest. Knives were sharpened and every investor baying for the blood of Cytonn's top management. The analysts at Wazua finally had their big laugh. Vindicated by the declaration of insolvency of Cytonn's high-yield products, the analysts poked every dumb person who trusted their hard-earned cash to Cytonn's scheme. Chaos erupted, single mothers cried, social media went berserk. Those who could afford a lawyer took to the law, and those who could not surrender to fate. The game did. Cytonn do anything illegal? No. The company managed to exploit a law in the CMA, Capital Markets Authority Act, that allowed them to source funding from the public without any oversight. By not having overt requests for funds, i.e. through advertisements, Cytonn could target high-net-worth individuals, suckers, via platforms such as LinkedIn, and present the offers. Apparently, all capital sourced by the public must be subject to CMAS regulation. This includes the central bank when it advertises for bills and bonds. The solicitation of CBK is subject to scrutiny by CMA. However, in Cytonn's case, the law allowed for non-scrutiny. Lessons: time manipulates risk. If I were to go for a short-term offer with Cytonn, 6 months to 1 year, I would have recovered the principal. Whatever is safe today is risky tomorrow. You are at the bottom. There is a tier of debtors. Just like you have ordinary shares and preferential shares in shareholding, there are preferred lenders and ordinary lenders. In this case, the preferred lenders get paid first in the situation of a liquidation.